Welcome to the AdviserLogic Cashflow Modelling tutorial. In this tutorial, I'll be taking you through our new and improved cashflow modelling tool. I guess just starting out talking about cashflow modelling, it is important to understand that you need to get the basics right before you start looking at too many different scenarios and too many different modelling options. So with that in mind, I would always encourage each and every one of you to create a current situation and check the accuracy of that before you start going off to model lots of different alternatives and different scenarios. Now, a couple of things to bear in mind when you are doing modelling is, of course, all of your projections are going to be based on assumptions. So you will need to make sure you've got the appropriate disclaimers within any documents that you're handing out to your clients with any form of projections. Within AdviserLogic, I would also encourage you to make sure that you've completed all of your data entry. Little things like putting in place the client's income and expenses, putting in the right ownership of different assets and loans, putting in the right insurance policies and who's paying those premiums. When it comes to things like the income and expenses, you've got the options also of putting in the start and end dates. All of those pieces of information are what get put in together to build the cash flow scenarios. Now, when it comes to the current situation, all of that stuff's going to build your current situation. Look at that current position and make sure that you're comfortable with that. When you are modelling the different scenarios, what we work on is that base initial one that you've built. So it's about building a current cash flow scenario that says, Joe, Joanne, clients, this is where you are right now. This is the information that you've told us. And based on what you've told us, we believe that you've got a surplus income of this much or a shortfall of that much. Now, when it comes to that, it is about checking it and making sure that it's pretty accurate. As an example, if your clients are saying that they're struggling to get from one paycheck to the next, but your scenario is showing them with a significant surplus or maybe even a shortfall, there's something not right in some place, whether that is in your data entry or in the information and the detail that the client has given you. So I can't stress the importance of making sure that the first scenario is data entered correctly and also double checked. And if changes need to be made, you make those changes. The reason for that is once you are happy that your current situation is being modelled out appropriately, you're going to use that as your base and you can start creating some duplicates or duplications, copies of that scenario to start adding in what it is that you're recommending that the client does going forward. And then you can compare the different scenarios to each other. The only other point that I will make before we get into how to use the cash flow tool is to remember that when you are comparing the different scenarios, that you will have changed things. Things will be different. You need to be able to then set those items up as recommendations within the other components or modules of AdviserLogic. So things that you do change within the cash flow tool are not going to feed back out and update the fact finder. They're not going to feed out and create your portfolio recommendations. So as an example, I've come in and I've built my current situation. Client's currently earning $100,000 a year. If I create a duplicate scenario that shows that the client's earning $70,000 because, I don't know, maybe they're, slowing down and cutting their days down at work, that scenario is not going to go and change fact finder. Fact finder income is the current situation. That's what they're doing right now. So changes that I make within cash flow will not change fact finder because they're in cash flow as ideas, as thoughts about what you might suggest that your client does, or that they've come to you and said, Gail, what would happen if we did this? And, what would our future projections look like in that situation? So with cash flow modelling, the idea is that you come in and, as I said, you add in your current scenario. I've already built in a current scenario, but I will now show you how to add in one from scratch. So the idea is that you click on the Add button. The first pop-up that you're going to get is kind of setting up the parameters of the scenario that you're modelling. How long do you want to do your projections for? Really important there to take the lead from your licensee, because if your licensee says that you should not be projecting for more than 5 years, please don't be doing long projections. Some licensees don't really mind, but take the lead from your licensee around what projection time frame that they are comfortable with. Some might have rules around that based on their professional indemnity insurance policy. So please just take that into consideration when you are modelling. The start year. All of our sheets are working on financial years. So of course you get to pick which financial year you're wanting to start your projections from. That will vary depending on the time of the year that we're currently in. When I'm recording this, it's August, so I am going to project for a full year. If I was doing my projections in, say, April or May, I might say let's just start from the next financial year, because by the time everything's in place, it's going to be the start of the next financial year. But that will vary on your own personal preference, the time of the year, but it's there that you can pick and choose when to start your projections from. CPI and a WOTI, again, talk to your licensee about what they feel you should be using in that space. That can be set as a default back through the administration tools of AdviserLogic. In the top corner, we've got an option to put in the client's retirement age and the partner's retirement age. As a standard, we will default to 65, but you could put in here that yes, he's going to retire at 65 and she's therefore going to retire at 63 or 62, whatever her retirement age is when he reaches 65. So you've got options around that depending on just what you're modelling. When it comes to risk profile, you are able to, through the administration tools, allocate your assumptions based on a risk profile. Your practice champions should know how to do that. If not, they can always reach out to our support team who will help them in that space. Having said that, I'm just going to pop one in here, say the moderately defensive risk profile for this client, and that gives me my income and growth rates as per what I've set up in my administration tools. The next one down is a description. So what is it that we're actually doing? I would always encourage you to use the description to be quite descriptive of what you're doing. Some of you won't. Some will just put scenario 1, scenario 2, scenario 3. It does make it hard when you're coming back into the scenario. I would always say something like pay down mortgage, I don't know, extra super contributions, whatever it might be, but something that is meaningful for you, that next time you come back into this client file, you're going to be able to easily go, oh, that's what I was trying to model in this particular scenario. Now, underneath here, we've got a few tick boxes that once again, we've automatically ticked on, but you can uncheck them if you're wanting to. So the very first one is, do you want to import the fact find data in order to commence a scenario? Why you would say no, I'm not quite sure, but usually speaking, you will have gone through the whole fact-finding process and completed all of your data entry. So ticking on this one just means that all of that data entry is going to be imported into Cashflow, ready to create that scenario. We're also now calculating the family tax benefit. We will look at the number of kids, the ages of the kids, income levels, the thresholds as they are currently within Centrelink rules. If you're wanting us to calculate the family tax benefit, simply tick that option on. If you're not wanting to include family tax benefit, you uncheck it. Now, that will vary depending on the level of your current situation data entry, because if you've not put in any dependents, then we're not going to be able to calculate the family tax benefit anyway. If you don't have the ages of the kids or the dates of births, we're not going to be able to calculate anyhow. But just so you know, tick it on if you want us to provide that calculation. The last of the options on this page is about optimizing the pension drawdowns. So a part of our Cashflow tool is looking at the client's retirement ages and saying, okay, that's when they're retiring, so their income stops. At that point, 99% of people are going to convert their superannuation balance into pension phase. We instantly assume that they will draw down the minimum pension amount. What this tool allows you to do is say, okay, we know that there's a minimum, but that might not be enough to cover the client's stated expenses. If you check this box on, what we will do is we'll say, okay, well, there's a minimum pension drawdown, but they actually need to draw a little bit more than that to cover their expenses. So by ticking this on, we're going to go and just automatically project out how much the client needs to be drawing out of their pension accounts in retirement to cover any cash flow needs that they have. So there's no more fiddling around by saying, yep, client's taking out the minimum, but we've got to take a bit extra to cover their expenses. By checking this option, we will automatically do that for you. Obviously, if that's unchecked, we're just going to assume the minimum pension, and then you're going to have to manually intervene to say how much is being drawn down on an annual basis to cover any shortfalls. Now, once you've done that, that's basically setting up the scenario. So when you click on the Save button, this is going to build all of those spreadsheets in the background to build out this particular scenario. It's going to be based on all of that information that I've done, data entry that I've done throughout the Fact Finder. So what you see in the first instance is a cash flow model for the client's overall position. So in the top left-hand corner, we've got a drop down that shows the client, the partner, and their overall combined position, which is the default of where you come to. You'll get the different years across the top, their ages in those years, and the opening balance. Now, the opening balance is the client's current cash holdings. So for these particular clients, I've got in that they've got just under $6,000 sitting in their cash account in their bank accounts. They have their income flowing through. They have some investment income. There's a pension and annuity heading. They don't actually have a pension kicking in for a few years, but at that point it does kick in. We've got some inflows for them jointly because in this case they've got a jointly owned investment property. We've got the family tax benefit, which based on their income is zero, but we're showing you that we're calculating it out to be zero. And then we have a row showing their total inflows. Underneath, we start seeing their outflows. So in this case, they've got some insurances, he's got some tax to pay, she's got some other expenses, and then they've got some joint expenses and their loan repayments. And at the end, in this case, we have clients that have got a significant surplus. That simply gets added to the closing balance of the bank account, which becomes the opening balance when we go back up to the top for the next year. All of their inflows, all of their outflows, and at the bottom we get the closing balance, which becomes the opening balance for the next year. Now, it's this one here, the cash flow in year one, that I encourage everybody to look at and make sure that they're comfortable with very early on. If the clients have said they're struggling to get from one pay to the next and we're showing a big surplus, there's something not quite right somewhere. It might be the other way, that we've modelled a shortfall and the clients are telling you that they've got savings to put away every week. If that number does not look right, go back and double check your data entry. Cast your eye back up over these numbers and see if they look to be fairly close to what you expected them to be. If not, obviously you go back to Fact Finder and change anything that does need to be changed, assets and liabilities that need to be changed. If your data entry is right based on what you've written down, it might mean that you need to re-engage with the clients and double check some of these numbers because something's not right somewhere in the process. So ideally, you will get year one looking pretty close to accurate. Obviously, cast your eye over the following few years because you do want to make sure that it seems reasonable in the context of what the clients have been telling you. But really important to get year one correct and accurate. So the way the rest of cash flow works is you go through and you make sure that the current situation you're happy with, and then up the top, I would actually encourage you to say, great, I'm now happy with that one and I want to lock it. So once you are happy with the scenario, I would say lock it and go, yep, that is the one I'm working on. That's my base. That's where I'm going from. You can export it out to Excel. So if you're just wanting to look at this one scenario in Excel to copy and paste into SOAs or to hand to the client, discuss with them, you can export out to Excel. You can copy the scenario. What that will do is exactly as it says, it creates an exact replica of this scenario ready for you to start building in what your ideas and what your recommendations might look like. You can click on edit, which will allow you to edit this scenario. So it's kind of like unlocking it, letting you to make some changes. As far as making changes go, it's really easy depending on just what you are wanting to do. As an example, if the partner was saying, look, that's my part-time income, I'm actually thinking about going back to work full-time, and if that's the case, my income would increase up to X amount of dollars. All I need to do is right-click on that income, and I can choose Edit Income. In that example, all I would need to do is say, let's change it up to, let's go with $80,000. Otherwise, I'm going to leave everything else the same. And then all I do is save that. What then happens in the background is that her income will be changed from the $67,000 up to $80,000. And in this example, that gives us a much higher surplus. So a simple right click and choosing edit has allowed me to model and say, Joe and Joanne, this is what it would look like if Joanne did go back to work full time. On the flip side, I could also right click and edit and reduce her income, or I could actually delete it and say, yeah, this is what's going to happen if you stop work altogether. I could also, through things like that edit, say, yes, but let's stop at an earlier age. So let's stop it before the client turns 65. Let's bring it back and say when the partner reaches the age of 50 that she wants to stop work. So there's all of those options by a simple right click. Now, I know I focused that on the income side of it, but you can do exactly the same thing on all the expenses. So with the expenses, I can right click and edit those as well. Depending on which row I'm on, I can simply go through and say, this is what I'm doing. I'm editing it, I'm changing it, or deleting and removing it altogether. Now, it's a very similar concept when we start looking across the tabs at the top. So as I said, the default when you first come in is the joint overall position, looking effectively at their cash flow. What have they got coming in? What have they got going out? The tabs across the top let me look at their other items. So if they own some assets, I can click on the Assets tab and I can see a list of their assets. Now, in their case, they've got their family home, which has got growth happening. They've got this, I've poorly named this one, but this is an offset account. They've also got an investment property, and this is another personal asset. I didn't name that one. I've just left it as a generic personal use asset. Any of these items I can also right click on. I've got a few more options when I right click in here in that I can edit the item, which is looking at income and growth rates, things like that. I could delete it if I went, oops, I shouldn't have entered that one in. I could organize a redemption. So if I was saying to sell this investment property, a redemption would allow me to do that. I could organize, not so appropriate for a house, but I could organize to reinvest any income as well. Or I could add more money to that particular investment, depending on just what I was wanting to do. Now, all of those are really straightforward, but I just want to highlight that with the redemption, you do get to put in when you're recommending that the asset be redeemed. You can also put in what the cost base is. So if I'm wanting to put in a redemption, I say create new. I can say what year I'm recommending they redeem that asset. I can choose full or partial. Now with a house, we actually default it to a full redemption, but you can change that if you're needing to. From there, you simply click on the Save button. Now, depending on the asset, sometimes you might need to put in the cost base. Wherever possible, we will put that in for you, but there are certain assets that you might find that you'll have another little box that asks for you to put in the cost base. Obviously, that's really important so that we can calculate appropriate capital gains tax or any losses that might be there as well. But otherwise, I simply click on the Save button, and that's going to project that in the year 2025 that asset is sold. Now, the income will also cease when we look at the cash flow modelling and everything else, so don't worry that that's staying there. it does allow you to go through and have a look at the cash account to say that the money's come in and the investment income has stopped. So I've sold an asset, the money's come in as an inflow, and right down the bottom we suddenly have a huge balance at the end. Chances are there's going to be a loan that also needs to be repaid. If I click on the liabilities tab, I will then go through and find whichever loan it is that was associated to that asset. Very much the same concept in that this one I would right click, and this time I can edit the loan, so change of interest rate, I can delete it, or additional repayment, which is where I'm going to repay the loan. So additional repayment again lets you go through and put in the year and the amount of the additional repayment. If you've got a larger credit limit, you can redraw back against the loan as well. But of course that is reliant on you putting in that the credit limit is this high and the loan balance is this low. So just remember that redraw will only be an option if your credit limit is higher than the current loan amount, which hopefully it will be. Next tab across, net position. This is exactly what it says it is. This is just a combined overview of the net position. So what have they got as far as assets and liabilities, their super funds, and then at the bottom of the page we look at their total net position excluding the home, their gross net position including the home, and then we can go through and have a look at the present values as well. Family tax benefit, bit of a furphy on this client because they're not actually eligible for family tax benefit, but just so you know, we are giving you the assumptions. So what are we basing our thresholds on? What is their income? What are their kids' ages and everything else? And then whether or not they're eligible for any family tax benefit payment. If I go back up to the top, when I click on either the client or the partner, the tabs at the top of the pages are slightly different. If Joe owned assets in his own name, the assets tab here would show me what he owns in his own name. The liabilities, any loans in his name. Taxation is where I can go to see how his tax calculation is coming about. So we've got his income, we've got any deductions, any taxable income, and therefore his tax payable. If he was eligible for any offsets, they would also appear. So if we fast forward a few years and he gets to the senior tax offset, that's when it kicks in at the appropriate age as well. If I wanted to look at what Joe has in super, I go to his super tab. We are no longer separating out the 5 different super funds that Joe has. What our cash flow tool does is says Joe's got, however many super funds it is, at the end of the day, he's got this much in super. It doesn't matter which fund it's in, we are showing quite simply that he's got X amount of dollars in super. His employer contributions are coming in, there's income and growth, so exactly the same concept as their overall position. What are we starting with? What's coming in? What's going out, including any insurance premiums that have been entered in, any tax, any Division 294 tax that's applicable, imputation credits, and the closing balance. The closing balance, of course, becomes the opening balance in the next year. And that process flows all the way through until he turns 65, at which point we go to the next tab, which is the pension tab, and that's when his pension kicks in. And just like the super tabs and their overall, this is the opening balance, the incoming, the outgoing pension payments, and the closing balance, and how that looks going across. And of course, if I scroll across a little bit more of the page, in this case, their expenses are obviously lower than the income and growth. So these guys are actually in a pretty good position because his pension is continuing to grow. This particular client, I've not added in an annuity, but we do have the option to add in an annuity. So if you've gone off to one of the providers and you've obtained a quote and you've entered in that they've got an annuity, it will show here what the annuity payments are. Of course, we know the difference between an account-based pension is that there's income and growth. Annuity, it's all about the actual income. The reason we have it shown in as a tab is so that we can perform the calculations around what's being assessed for the age pension. So of course we then move to the age pension tab. You'll notice that instantly it's a much smaller screen because for this client it doesn't kick in until the age of 67. So we don't actually start projecting out until 2035. like the family tax benefit page, we show you what our thresholds are, what we've assumed or projected the thresholds will be. We do the income test calculation and how much we believe he'll be entitled to under income test. And then if we scroll down, we do the same process for the assets test. And in this case, these guys have got too many assets, and as a consequence, they won't get any age pension either. Okay, back to the overall position. Just to show you this little one, there is also another button up in the top right-hand corner that allows you to see a graph. The graph will vary a little bit depending on which page you're on. So I'm on the overall position, so it is showing me my inflows versus my outflows. Income's blue, the darker blue or the black is the outflows. So we can see all the inflows and the outflows the way across. If I was on the assets or the liabilities tab, I'm going to see my asset value versus my liabilities value and see how that changes over time as well. The other button up the top is an add button. So the lines allow you to edit, copy or export or lock. The add button lets me add in any new items that I'm wanting to add in. So coming back to that scenario before where I said you've got your current situation and that is what it is, right click to edit to make it match the position that you believe the client is in. Once you start modeling the alternatives, again, you copy that scenario, so you're starting from the level playing field, but you might start adding in new items. If it is simply editing an existing item, you right click and you get the edit and you can change whatever it might be, like I did with the income. I would just simply right click, edit the income. If on the flip side, it might be that mum's currently not working, so the current situation has her with no income, but my modelling scenario or my alternative scenario might be what happens if mum does go back to work. I can add an income source. Now, adding an income source is same concept. It's about going through and how much, who is it, when are we starting, when are we finishing, and all of that other input that you would normally do under a current situation of income. We have lots of other add items. So expenses, super contributions. If we're recommending they purchase a new asset, you would add in an asset as well. A new loan, a new pension. So as I mentioned before, we're going to assume that we're going to start a pension at the age of retirement. But if you actually are saying to your clients, I think you should start your pension earlier than that, maybe they're dropping down to part-time work and doing a TTR, you can enter in to say that you are starting a pension. Tax variance is one of those options that allows you to effectively trick AdviserLogic on its tax calculation. So we generally go through and say this is the client's income, these are their tax deductible expenses, and this is their taxable income. Every now and then you might want to trick the system into thinking that the client's taxable income is higher or maybe even lower, especially if they do have carried forward capital losses that you've not stored anywhere else in AdviserLogic. So tax variance simply allows you to trick the tax calculator into thinking the client's income is higher or lower. You might also be recommending the client adds in a new annuity. So that's one of your recommendations. The fields around an annuity are different to when you're doing pension, purely because it's got the different Centrelink calculation. The last two buttons down here, cash management and cash deficit, are where you can go and look at how to manage the client's cash flow. So if your clients do have a significant cash flow or even just a cash flow surplus, you might be wanting to say, going forward, we want you to direct all of your surplus into your home loan. Cash management allows you to do that. It's an all or nothing. So you're coming in here and you're saying, I want you to put all of your surplus to paying off a loan. When you choose a loan, you get to say which loan you're wanting them to repay first. When are we starting it and when are we finishing it? What proportion of the surplus? So it might be 50% of the surplus, it might be 100% of the surplus. And your description. That might be something just like extra loan repayments, pay down loan, surplus to loan, something along those lines. And then you save it. What we do in that instance is all of the surplus gets redirected to the loan until such time the loan has been repaid. There are other options around cash management in that you can set up to say put extra money into super, don't carry it forward just means that we're writing off any surplus that there might have been or adding to another investment. The other one there, the management cash deficit, is the exact opposite. This is when your clients have a shortfall. Where do you want to draw that money from? So you can come through and you can say draw down on loans, draw extra pension payments, or start selling down some assets to cover any shortfalls that might be there. Now, one that I kind of skipped over back up near the top is where you go to add in new expenses. So with expenses, it might be that the clients have come in and said, look, this is where we are now, but we'd really like to take a holiday every few years. So what you can do is come in and say, look, in today's dollars, the client's telling me they're spending $5,000. It might be a joint expense, it might be a lifestyle or other discretionary, whatever kind of expense type you want to call it. When are we starting it? How long is it going to go for? Whether you want that $5,000 to grow with inflation, CPI or WOTI. And then you've also got the option to say how often is that expense going to recur. So it might be that they say, look, we want that holiday every 3 years. Whether or not it's tax deductible, offsetting age pension, all of those sort of items, and your description. So you might call it holidays. And you can pop that in and save it. What we'll then do is when we go back and look at the actual cash account, we'll start seeing expenses coming out every third year around their holidays. So we've got holidays this year, 3 years later, 3 years later, and so on throughout the process. You can use that for all sorts of things. I know I've used holidays because that's the fun one, but it might be that your clients are upgrading their car every 5 years. It might be that, every few years they know they're going to be hit with a big maintenance fee on their house. That's the kind of thing that you can put in with that expenses and when you're projecting it out over time. Okay, you may have noticed a little plus sign down the bottom. This will vary, or the options under it will vary depending on what page you're on. So when I'm on the overall position, I've got the option to add in extra income expenses, cash accounts, or cash management options. If I'm on the assets tab, those options will vary again in that I can add in a new investment portfolio, a new investment property, personal use asset, or a new family home. When I'm looking at liabilities, again, the options will be slightly different in that I can add in principal and interest loans, interest only, or interest only, and at a later stage, a principal and interest loan. So that's another relatively new thing we're looking at, is being able to say, look, we're going with an interest rate of, 4%, and the interest rate percent after that is going to be 5%. And you can go through and you can put in the different parameters around. For the first bit, it's interest and then principal only. For how many years is it going to be interest only and then thereafter? So it's all about putting in the relevant data entry to make sure that the loan is set up and structured the way that you want it to be. So interest only plus principal and interest is looking at saying, look, we've got interest only for the first 3 years. After that, we're going to flip to a principal and interest loan. This is what we believe the difference will be in the interest rate. So you've got your pre and your post interest rates as well. Obviously, that's probably going to the next level in that you could also just do a standard principal and interest loan now or an interest only loan, which will project that on that basis for the next X number of years. Okay, so once you've done that, you've now got your second scenario. You might go through and you might copy that one and add in a few more recommendations. You might go back to your first scenario and copy it to make something different. So when you've got your current situation, that is what it is. You can create a copy that might be to pay down the loan. You might go back to your current situation to create another copy to put all the extra money into super. You might then have another scenario that you do again with a little bit of both. That's why it is so important to get your current situation correct and accurate based on where the client is right now. So once you've got your different scenarios, the arrow up in the top left-hand corner will take you back to the overall cash page. This, in my case, I have two different scenarios. There's not a significant amount of difference in my modelling. I don't think when we see the different graphs side by side, it'll be a little bit different. I haven't really changed that much. When I tick on the different scenarios, and I can tick on lots of different ones. I've only got 2 in here at the moment. I then have the option to compare. Now, when I'm looking at my comparisons, I'm going to see lots of numbers, and I'm also going to see some graphs. And what that will do is let me show my clients one scenario against another. Now, you might notice it's lagging a little bit with coming up. Unfortunately, that's because I am recording this session via GoToWebinar, which is slowing the internet down. It won't lag this much if you're not running so many different programs behind the scenes. But the idea of the comparison is so that you can then show your clients, look, if you don't do anything, this is where you're going to come out. If you put in place my recommendations, this is where you'll come out. And you might have a couple of other alternatives in there that you're showing your clients where they actually sit based on a couple of different scenarios. All right, that pretty much sums it up for cash flow modeling. So as I said, it's really, really important that you come back and you get your current situation looking accurate, because that is what you're going to use as your base to build on with your different alternatives and different scenarios. I hope that's helped explain cash flow modeling within AdviserLogic. I think the key things to remember are getting your current situation accurate, remembering right click, because right click is what allows you to edit and change anything that is already there. And then the add button up in the top right hand corner, because that's going to let you add in any new items. Okay, that wraps it up for cash flow modeling. So thank you very much for your time. As always, if you have any questions, we do have our support team that are more than capable and more than happy to help you out. So their contact email is simply support@adviserlogic.com. Thank you everyone for your time.